morning. I just want to introduce you George Selgin, if I'm not mistaken with the pronunciation. He's a professor at the University of Georgia, and this is called the Cato Institute, and frequent guest speaker at the Free University too. We almost every year have him here. He's a researcher in the various wide range of topics in the field of economics, especially in monetary theory and banking theories. And today we have a lecture on Federal Reserve dismissal court. So the floor is yours. Thank you for coming.
Thank you. Thank you all for being here. This is the topic that I was asked to lecture on. It's something I've been writing about and researching for some time, mostly though with the purpose of presenting my findings to American audiences, of course, and including audiences in my home state of Georgia, not particularly to present here in this Georgia, but I actually think that the subject matter is one that should be of interest to people everywhere, and allow me to take a few minutes to explain why I hope it will interest everybody here. And I'd like to ask if everyone would be so kind as to shut computers and cell phones and things so that we both have each other's undivided attention. I'll try to earn yours, but for now I'm going to ask for it on credit. But let me explain then why I think you want to know about the Fed's record. The Federal Reserve, of course, is one of the most famous and influential central banks in the world. And one reason that's true is because it's one of the better behaved central banks in the world. I think if anyone takes a moment to examine the broad experience of central banking, including all the central banks of Latin America and Africa, and of course Eastern Europe and so on, they will discover very quickly that the number of cases of central banks that have behaved horrendously is very, very large. And indeed, I think it would be a very safe thing to say that the average central bank is not something anyone would wish to have in their country. Of course, if your country has a really bad central bank, you might be happier with an average central bank. But if your country has at all a responsible monetary policy, the average central bank will do worse. So this is not, though, a lecture about the average central bank. It's a lecture about one of the best central banks to judge by the normal criteria of success. But at the same time, and this is the import of this lecture, I hope I can convince you that the record of this superior central bank, which has been so influential, is actually, as I write here, dismal, a terrible record. It's a failure by any reasonable criterion, but especially by according to its own stated objectives. Now, the reason why I think this is important is because many countries have only embraced central banking in relatively recent decades. Central banking is mostly a 20th century phenomenon, and for quite a lot of countries, it's a phenomenon of the last half of the 20th century, and for some countries, it's a phenomenon of the last 20 years. That includes those countries that have relatively recently become independent of the former Soviet empire, and so have established their own currencies. In almost every case, though not all, they did so by establishing their own central banks. And the reason they did this is because of the perception that if they were lucky, they could have a really good central bank like the Fed. Well, I want to suggest to you that even if you are that lucky, that's not so lucky, by showing you how the Fed has in fact performed. Now, in another time, given enough time, I would also spend a lot of time telling you why we don't have to have a Fed and why there could be a better system. I'll give you some hint of what I mean by that in talking about U.S. history, but I'll save that for the latter part of my talk. I also would like to make a rule that having asked for your undivided attention, I also welcome your questions. If you wish to interrupt me at any time with a question, that's all right with me. We're used to this, and I like it. I also will, I hope, that we'll have time for questions afterwards if people prefer to ask them then. But if there's something that doesn't make any sense to you, don't hesitate to ask me for a clarification right away. That's fine. All right, we'll begin with the events that immediately led to the creation of the Federal Reserve in 1914 in the United States. The proximate event, the one most obviously responsible, was the panic of 1907. There's a big financial panic and crisis, more or less 100 years before the most recent U.S. financial crisis. It was perceived to be very serious, and what's more, it was one of what had been a series of crises in the decades leading to the Fed. Now, in response to this latest crisis, the government created something called the National Monetary Commission. And this commission was charged with doing two things. First, making a systematic study of the world's monetary systems, including the U.S. system, and then reaching some conclusion about how to reform the U.S. system. Now, I won't at present go into the various debates and alternatives that were discussed by the Commission. For now, it suffices to know that the ultimate outcome of this Commission was, of course, the passage of the Federal Reserve Act by Woodrow Wilson in 1914. And, of course, the Federal Reserve had as its most obvious objective the goal of preventing future serious financial panics like the Panic of 1907. It had other objectives as well, which are stated in the Federal Reserve Law or have been stated subsequent to the drafting of that law by various officials at the Fed. Here I give the most important components of the Federal Reserve's mission. These are, first, to promote effectively the goals of maximum employment, stable prices, and moderate long-term interest rates. And second, to contain financial disruptions and prevent their spread outside the financial sector. These brief passages roughly summarize what it is that the Fed claims that it is accomplishing or is supposed to accomplish. Now, what I want to do is to evaluate the Fed's performance according to its own statements about what it is supposed to achieve. Doing so is going to involve unavoidably looking at a lot of statistics, right? Some of the statistics will be obvious ones, some will be a little bit fancy. I'll do my best to explain them, but I try to use the statistics that most economists would agree are the appropriate ones for examining the criterion of performance in question. Although it's a very important task of the Fed, I will not spend too much time on the matter of unemployment. And there's a very simple reason why. Although it's certainly true that the central bank has an important marginal influence on unemployment, especially in times of crises, its overall and long-run influence on the level of unemployment or employment is, well, a small influence relative to other factors in the economy. No one would look at the United States rate of unemployment at any time, especially in a time when there's no crisis, and assume that the Federal Reserve is the main thing responsible for the unemployment that exists. Nobody would say that. So it's very dangerous to draw conclusions about the Fed's performance by looking at how the unemployment rate has changed since 1914. It's almost impossible without much more complete analysis of other determinants. Nevertheless, for the record, I showed here how, according to the best statistics available, the rate of unemployment has fluctuated in the United States since 1870. We don't have meaningful statistics before that of any reliability. And what you find here is, if you look at the average rates of unemployment for different periods, you find that the period before the Federal Reserve, before 1914, was one of relatively low average unemployment, a little bit above 5%. Then you have, of course, a much higher average rate of unemployment between 1914 and the end of World War II. Then there's a briefer period after World War II where the unemployment rate is slightly better than it was before 1914, and since then it has been worse again. If you take the whole Federal Reserve period and compare it to the pre-Federal Reserve period, you certainly can't say that there's been less unemployment. On average, there's been considerably more. Is this the Fed's fault? Very hard to say, though we will see a lot of reasons for suspecting that during the interwar period, the Federal Reserve was playing an important part in it made an important contribution to the high unemployment during that particular period, to the exceptionally high unemployment then. But I don't want to go too far with this. It is useful merely for countering claims by the Fed, which it does sometimes make, that it has kept unemployment lower than was the case before. And indeed, I want to be clear, much of what I'm going to say today is really aimed at countering Federal Reserve propaganda. Because if you read that propaganda, you'll find them claiming that they've improved, unemployment has been lower since the Fed, business cycles have been less frequent, fluctuations in output have been less severe, prices have been more stable, and so on. And I want to show you that those claims are false. Whether they're false because the Fed has screwed up or for other reasons is a little bit more difficult to establish, though I'll try to give some suggestions. So let's move on to something for which we can all agree the Federal Reserve is chiefly responsible. This is the behavior of prices in an economy, right? The behavior of prices, being nominal money magnitudes, clearly depends fundamentally on the behavior of the monetary system, right? And so we can say that if prices are rising excessively rapidly, then if the Fed is present, if you have a central bank, then the central bank bears a lot of responsibility for those price movements. Even if the ultimate sources of the price movements are factors other than the central bank is in a position to counter those factors and so make prices behave in a manner it deems desirable. And here you have the current Fed chairman, Ben Bernanke, making a typical statement about why stability of prices is important. He says, stable prices allow people to rely on the dollar as a measure of value when making long-term contracts, engaging in long-term planning, or borrowing or lending for long periods. It should be periods with an S. So keep this quotation in mind as we ask whether the Federal Reserve has provided the sort of stability in prices that is being referred to here, has enhanced the stability of prices in a way that has made it easier for businessmen to contract, and so on. Let's take a look. Well, that the dollar's purchasing power has become less stable in the simple level sense since the Fed was established is almost too notorious to be worth pointing out. Prior to the Fed's establishment, and indeed pretty much at the date of the Fed's establishment, the consumer price index in the United States was almost the same as it was when the very first statistics were available, when the first calculations available are considered, and those go back to 1790. There was relatively mild fluctuations in the price index, some not so mild, but nothing like what has happened since the Fed's establishment. But almost immediately coincident with the Fed's establishment, you find that deterioration of the purchasing power of the dollar or increase in the general price level becomes persistent. There's a very sharp increase in prices immediately following 1914 during the war. Very sharp. You know, the worst inflation rate in the 20th century in the United States, to judge by monthly statistics, was not experienced in the 1970s, but rather in the years of World War I and immediately following, though often people forget this. In other words, the highest annual rates of inflation we've had have been for the years immediately following the Fed's establishment. Then, of course, you had a period of deflation in the 30s, about which I'll say a little bit more in a moment. And then you have, after that, a persistent rise in prices, which becomes much more rapid after 1970. And that is not a coincidence. What happens after 1970 is the last links of the dollar to gold are severed. And the significance of that for us is that that means that after 1970, the Fed's power to control the price level was actually more complete than ever before, because it didn't have any gold standard that could influence it or constrain it. But this means that when the Fed had nothing in its way, when it was able to do whatever it wanted to, in effect, with prices, that's when prices became less stable than ever before. Here's let me just look up at this again. Today, it's common for the Federal Reserve officials, Ben Bernanke, to speak of 2% inflation as a lower bound, a conservative, safe inflation rate. And this just shows how much thinking has changed on this subject as we've become accustomed to inflation after having experienced so much of it under this regime. But let me just give you a comparison that will be food for thought. People sometimes criticize the gold standard and silver standards by saying that with such a standard you could have new discoveries of gold that could themselves prove inflationary, and of course that's true. But think about it historically. What was the most dramatic discovery of gold and silver ever in history? Anyone? When was the biggest gold supply shock ever so far?
The discovery in America.
Of course, of course. And it was mainly gold from Mexico then that came pouring in to Europe, gold and silver. And the result of this is what historians call the Great Price Revolution of the 16th century. 16th and early 17th century. And this is the big inflationary supply shock that the biggest we've ever seen as a result of a gold or silver as opposed to paper money issued by central banks. But that price revolution consisted of a 5-fold increase in prices in 150 years. If you calculate the annual inflation rate, the average annual inflation rate is less than 2%. In other words, according to Bernanke's criterion, if he had been a central banker in 1650, he would have said, oh my God, we're much too close to the zero lower bound, we don't have enough inflation. So this gives you some perspective. Of course, with 2% inflation, the price level doubles every 72 years. So that's another thing to keep in mind. I'm sorry, every 36 years. With 1% in 72 years. Pardon me. Now, there's actually an important distinction we have to make before we finish with assessing the Fed's effect on prices between what the price level is doing and how predictable the price level is. They're not the same. For example, if the price level were rising according to a perfect exponential function, say, right? Then, of course, we would be able to predict the price level in 10 years, 20 years, 30 years. In that sense, because the increase is smooth and steady, it would not represent instability of the purchasing power of money. So actually, the chart I showed you a moment ago doesn't quite say the Fed is screwing up. But we can assess whether the Fed's screwing up by doing a different kind of statistic, calculating a different kind of statistic, which, at the risk of boring you, is called the forecast error, right? This is where we take a simple forecast based on how the price level has been behaving so far up to a certain date, and then we ask, how wrong would we be if we forecast the price level in 5 years, or in 30 years, or in 100 years, using the trends we've seen so far? These charts show the forecast error for the pre-Fed period and for the post-Fed period. And what's interesting is, as you can see, the error, the numbers are the same from left to right, so the scale is the same, right? The forecast error for before the Federal Reserve, right, was not on average much different for the 5-year horizon, that is predicting 5 years away, than it was for the post-Fed period. But as we look at longer-term horizons or forecasts, the errors become substantially greater in the post-Fed period, much greater in the 30-year horizon, and far greater in the 100-year horizon. What this means is that, going back to Bernanke's thought about the entrepreneur, the long-term investor, the entrepreneur or investor making plans for 5 years ahead is not much worse off than an entrepreneur would have been under the pre-Fed gold standard arrangement, right? Maybe it's hard to say what's better here because of the variance in the post-Fed example. But that entrepreneur would have had a much harder time forecasting the price level and making proper decisions according to that forecast for the 30-year horizon, and a much harder time for a 100-year horizon. Now let's think about bond markets and borrowing, which is the other thing Bernanke mentioned. When do you think, if you were either going, suppose you were going to try to float a bond or buy a bond, and suppose I was offering you a bond, how willing would you be to buy a 5-year bond from me before the Fed or after the Fed, based on the price level uncertainty you face? Don't answer the question. The answer is you would be equally willing. But what about a 30-year bond? Would you think a 30-year bond with a fixed coupon rate of interest, mind you, right, would be safer before the Fed or after the Fed?
Before.
How about a 100-year bond?
Even more.
Well, a 100-year bond is a mess, right? Well, guess what? If you go back to the pre-Fed period, it was actually quite common for some enterprises, railroads in particular, and governments too, to issue 100-year fixed coupon bonds before the Fed. Because look, you can see the forecast there. Actually, under the old gold standard, right, the longer you waited, the more likely the price level was going to end up where it began. That's why the forecast error for 100 years is so low. The gold standard had this characteristic before it was combined with central banking. But today, forget it. 100-year bonds disappeared from the marketplace, more or less coincident with the Fed being established. So these statistics really suggest that, according to Bernanke's own statement about what we want the price level to do, about wanting it to be stable, that the Federal Reserve period has been much inferior to the one it replaced. Now, there's one more thing I need to say about prices. We're spending a lot of time on them because they're the most obvious thing the Fed controls. Some people will say to you, and they've said to me, well, okay, so the Fed has generally erred in the direction of inflation. Of course this is true. But at least it has prevented deflation, except in the 1930s. That's a big exception, by the way. But okay. But actually, it turns out that the Fed's record on deflation is much worse than might first appear to be the case. Can you all see down here? Can you see the screen? Okay. Oh, that's right there at an angle. Okay. So the reason the Fed's record is worse than it appears and worse than the pre-Fed system is because there are two kinds of deflation, and these two types of deflation need to be distinguished. They're often not distinguished carefully, if at all. First, there's a good kind of deflation, which is what's depicted here. Good deflation happens when the level of demand in the economy is stable, right? Aggregate demand, nominal spending. So monetary factors are stable, but the supply of goods is growing, so goods get cheaper, and you have lower prices and more output. That's good. People are happy. They go shopping, right? That's why there's all the smiley faces here. And technological innovations, of course, are a very important source of good deflationary pressures. The deflation that was the common in the 19th century, there was persistent deflation, very gradual, in the later part of the 19th century, the last quarter, was almost all supply-driven, productivity-driven deflation, good deflation. Not all of it. There were crises when you had some bad deflation mixed in, but for the most part, the deflation is good deflation. Then, of course, there's bad deflation. Bad deflation happens when there's a collapse in aggregate demand, and then, of course, prices go down, and so does output, and employment goes down as well. And, of course, this is something we want to avoid. Well, it turns out that there weren't many really serious episodes of bad deflation before the Fed, but the most serious episodes of bad deflation are the ones in U.S. history, are the ones that have been in the post-Fed period. There was the one of 2021, the most notorious of all, from 1930 to 33. Another pretty bad one in 1937, 38, and then most recently the deflation of 2009. All of these happened under the Fed's watch, and it's hard to find similar episodes of extreme bad deflation before the Fed. So the Fed has gotten rid of good deflation, but it's given us more bad deflation. Here's, though, a study that sums up the conclusions on this for a number of countries, and says that was from the American Economic Review a few years ago. A broad historical look finds many more periods of deflation with reasonable growth than with depression, and many more periods of depression with inflation than with deflation. So the Fed's, although it's true that inflation is now much more common than deflation, this itself is no proof that the Fed has done more good than harm. And a closer look at the evidence suggests the opposite. Of course, the depression of the 30s was the most notorious failure of the Fed. And here you can see what was happening to the consumer price index and also to real gross domestic product. Consumer price index is the blue line, and real GDP is the red line. And this is a very clear case of bad deflation, where you have prices and output both falling at the same time because demand is collapsing. And this, of course, is happening under the Fed's watch. There you can also see another smaller episode of good deflation, of bad deflation in 37, 38. That too, by the way, was entirely the Federal Reserve's fault. In the first episode, as Milton Friedman and Anna Schwartz have now convinced everyone, the Federal Reserve failed cataclysmically to perform the very function for which that originally inspired its creation, that of lender of last resort to prevent financial crises. It more or less refrained from doing anything to prevent the banking collapse and subsequent monetary collapse of the early 30s. Then in the later 30s, at a time when it should have welcomed more lending and more spending, it feared that these things would cause inflation, an odd thing to worry about when prices are still markedly below their pre-depression level, and began a process of doubling reserve requirements that caused a secondary depression within the Great Depression, or as part of that aggravated and continued the Great Depression. This shows you the Fed's neglect during this time. The Fed controls or had the power to add to the monetary base. You see how in the 30s the monetary base is almost flat, whereas the money supply is collapsing. The Fed could have offset and prevented the collapse of these money measures if it had expanded the base more. An important point I'd like to make here, sometimes you hear that the reason the Fed couldn't expand the money supply or the monetary base, which is bank reserves, was because of the shortage of gold, because of the gold standard. The Fed had excess gold reserves throughout the entire period in question. It began with a very large quantity of excess reserves in 1930. when the banking crisis culminated in the bank holiday in 1933, it still was holding $1 billion in excess gold reserves. So the problem was not gold. It was not gold. Here is a chart that shows you a little bit more about the Fed's uselessness, if I may put it bluntly. It is, in fact, true that eventual recovery from the Great Depression in the United States was due to monetary expansion. Finally, the money supply started to grow again, and that helped to revive spending and end the bad deflationary pressures that had caused the Depression in the first place. But if you look at this chart, you can see that the Federal Reserve is doing nothing. Federal Reserve credit remains flat during the 30s and early 40s, perfectly flat. What's happening is the gold supply is increasing. First it increases because of devaluation, which happens in 34, and the rest of the increase is gold coming in from Europe, mostly after Hitler becomes chancellor. You can figure out why that's happening. So the Fed sits idly by. Fortunately, these other events lead to some recovery, which is only completed in the course of or after World War II. So we have a Fed that is, and I'll talk more about this, clearly not acting to prevent or a crisis or to speed a recovery. And let's talk a little bit about more about output. This is controversial, but the most obvious measure of stability of output, of course, is the standard deviation of output, right, or output GNP. Now, the old statistics, there were statistics that had been relied on for 40, 50 years, and that's shown in this series. I'll have to step up here to explain a little bit. According to these statistics, the standard deviation of output before 1914 is somewhat higher than the standard deviation after 1914 for the full sample. Now, of course, it's only a little bit higher. It's not that much higher, but it is higher. Now, of course, if you look at the interwar period, the Fed's performance. I'm misleading you. If you look at the period before 1914, it's considerably higher than post-1945. According to these statistics, it's higher. So the Fed seems to have made things better, but it took until 1945 before it started doing so, according to these statistics. If you add the full post-Fed sample period, then even according to these statistics, the Fed has had a destabilizing effect on average, assuming that the Fed is responsible for the standard deviation of output, right? And other things are responsible for the trend, which is not completely unreasonable. It's not the whole story. Now, some people will say, well, look, the Fed has improved things because after 45, things got more stable. What they're really saying is we shouldn't count the first 30 years of the Fed. That was practice. But this is, of course, begging the question. Why would, 30 years of practice doesn't seem to be, it's a long time, and what a way to practice. But a more important point is that the statistics that you see here are no longer considered accurate, mostly because the pre-1914 series have been revised. They were based on actually very naive extrapolations from commodity price behavior, and we now know that those extrapolations were wrong. It's actually the lady next to Tim Geithner who's responsible for our new knowledge of the variability of prices. And I show you her picture because she was president of Obama's Council of Economic Advisors. So she's not an Austrian economist or anything like that. She's Christina Romer, a very famous economic historian. And her revised statistics look like this. Now, if you look at these statistics, it turns out that even if you just compare pre-1914 to post-1945, there's been no improvement. It's trivial improvement. But now, of course, if you compare pre-1914 to post-1914, the Fed's performance looks extremely bad. So the early statistics exaggerated the volatility of pre-Fed output and gave a false impression of how much more stable things have gotten. There's one more thing I'd like to say about volatility of output, though. It's part of a broader point that we should all implicitly understand. Of course, it's not correct to say that everything that happens after 1914 to the volatility of output is because of the Fed, right? Other things change after 1914. One thing that changes is we have the Fed, before we didn't. But a million other things are changing in the US economy. It's possible that things are changing after 1914 that contribute to instability of output, even though the Fed is contributing to greater stability of output. It's possible. Yet, it's hard to identify such things. In fact, there's only one thing I can think of. The things I can think of that would have made a difference to stability of output after the Fed, besides the Fed itself, after 1914, all should have made output more stable. Let me give you just one example. It's easy enough to understand. Fiscal policy, right? Fiscal policy is potentially stabilizing. Indeed, even if the government just acts passively, there's a natural tendency for fiscal policy to be stabilizing because government keeps up its spending during downturns, and so there's an automatic stabilization built into government, the government account, the government component of GNP. Governments don't go broke when other firms are going broke. They keep on spending, and they may even increase spending for entitlements and such. So fiscal policy is contributing potentially to stability. But what's the contribution of fiscal policy proportional to? The size of government. If government is a bigger chunk of GNP, you would expect these fiscal stabilizers to be more important, and so you would expect GNP to become more stable the greater the share of government. The share of government, oops, where's the chart I wanted to show you now? There it is. Here's the share of government to GNP, and as you can see, it's flat before the Fed and then starts rising. Eventually the share of government becomes 3 times as much what it was before the Fed. So all that period when the government's growing, and this is just federal government outlays, all of that should be reducing, ceteris paribus, should be reducing the standard deviation of output. So if we consider that, and we consider that output is, if anything, on the whole, after 1914, a little more unstable, or a lot more unstable, depending on what dates you include, then we are given more reason to suspect that the Fed is doing a bad job when we take this other factor, very important factor, into account. I can't think of any other factors that are as important as this. We can talk about the change in the share of agriculture, we can talk about other things, but none of them have the obvious systematic effect that government spending should have. Christina Romer, to continue talking about, what's this? Oh, I wanted to show you the 2009. Now, these statistics I was just showing you are before the crisis of 2009. If we throw in that crisis, obviously we're going to have the post-Fed period looking worse, right? That also is true regarding this quote. We can look at the standard deviation of output. That's one way to look at stability of output. Another way is to look at the length of business contractions or recessions, the length and the persistence. Now, in other words, here we're not looking at how much GNP bounces around, right? We're particularly worried about when it goes down, right? And there's good reasons to worry about that more than when it's just bouncing, because if it bounces up, well, that's great, you know. So what if we just look at contractions, that is, periods when output is shrinking instead of growing, and we ask, have they been less or more frequent since the Fed? Have they been longer or less long-lasting since the Fed? Christina Romer also did a study of this, and here's her conclusion. The average length of recessions is actually 1 month longer in the post-World War II era. Post-World War II, she's leaving out the practice period, right? We know what's going to happen if you throw that in, right? In the post-World War II era, recessions have been a month longer than in the pre-World War I era. There's also no obvious change in the distribution of the length of recessions between the pre-war and post-war eras. Christina Romer, 1999. 1999 is important, because this is not counting everything that's happened in the last 12 years. If you add those in, you're going to find that recessions are now on average more than a month longer since World War II, and so on. Now, last topic, because, last topic before I give you a little bit of historical background and conclude, is panics, banking panics. Everyone claims that the Federal Reserve has made banking crises, banking panics less common than they used to be in the pre-Fed period. At least they used to claim that a lot. Now they're not talking about it quite as much as they used to, for obvious reasons. But I'd like to suggest to you that the Federal Reserve has never played any role in reducing the incidence of bank panics in the United States. I'm going to repeat that. The Federal Reserve has never played any role in reducing the incidence of panics. In fact, a careful look at the evidence suggests that the incidence of panics has gotten worse since the Fed. Now, that's hard to believe since we had few panics for a long time before the recent ones, but let me try to do it. Here's a chart that shows U.S. bank failures since 1892. And this chart, we could measure this in deposits of failed banks. We could do it a number of ways, but it'll all look about the same, and it'll also and we can also rely on bank failures or clusters of them to be an indicator of banking crises. There's no problem with that usually. Well, as you can see, yes, there are lots of clusters of bank failures before 1914, particularly nasty one in 1893. That was one of those big panics. But then after the Feds established, after a relatively short period of a couple years, we find that the incidence of bank failures grows dramatically and continues to do so right until the bank holiday of March 1933, when they pretty much stopped with a small residual afterwards. Now, you might be tempted to conclude that the lack of banking failures, relative lack, and lack of evidence of bank panics from 1934 to the 1980s, when we started having the S&L crisis in the U.S., you might say, well, look, for that whole period, the Fed has done a good job. So maybe here we have another example of where there was a learning period, a practice period, but then the Fed got its act together, but that's not what happened.
Excuse me.
Yes?
Could you remind when this deposit insurance was introduced?
Yes, it was introduced in 34, and that's just the point I'm getting to. The real thing that put an end to the banking panics and crises was well, there were two things. Ultimately, it was the creation of the Federal Deposit Insurance Corporation in 1933, which removed the incentive for runs on banks and basically propped up even weak banks for a long period. Actually, just before that, the Reconstruction Finance Commission was involved, because the Federal Deposit Insurance Corporation didn't actually get going until June of 1934, so there was this interim kind of insurance arrangement between March 33 and June 34. And between them, they are what put an end to the banking crisis of the Depression and made banking crises disappear for some time afterwards. Now, I have to quickly say that I'm making this point that if we consider the influence of deposit insurance, then we no longer find that the Fed has much of a role to play in the reduced incidence of crises. That does not mean that I'm an advocate of deposit insurance. The reason deposit insurance was established in the United States was as a substitute for having a structurally sound banking system. Basically, the story is this. The U.S. went into the Depression with 30,000 lousy little banks, basically. Right? Under-diversified, no branches. They were very weak, and when things went bad, they failed in large numbers. Not just in the Depression, but as you saw in the 30s. By 1933, nobody would have done any business with these lousy little banks unless they had insurance. But that didn't mean insurance was necessary. If we had reformed the banking system by allowing nationwide banking, then we would have had safe banks. The proof of that is Canada. Canada had nationwide banking in the 1930s. Its banks could branch throughout the country and were therefore large, well-capitalized, and diversified. How many Canadian banks failed in the 1930s? Does anyone know?
Very few.
Zero. Yeah, very few. Zero. So they didn't have insurance, and they didn't establish insurance until, I think, 1970 or something like that. So it wasn't insurance. So obviously you don't need insurance. In the most recent crisis, of course, we can ask whether the Fed has played a role in making it less severe than it would have been. This is what the Federal Reserve and its apologists claim. But I think I agree with Willem Buiter, who says that on the whole, Fed interventions in the recent crisis, including its rescue of Bear Stearns, appear, quote, to have been designed to maximize bad incentives for future reckless lending and borrowing by the institutions affected by them. I think that I could go into a whole lecture about the Fed's conduct in the subprime crisis. It is not a nice story. I don't think that that episode at all rescues the Fed from the charge that it has not improved the situation with respect to financial crises. I'm sorry I don't have a quote.
May I ask a question?
Yes, you may. I had a quote from Elmas Wicker, and I'll just have to paraphrase it because I don't have a slide. Yes?
Okay.
You want me to go back?
That was a well-taken point regarding this Fed's role, peer finance, rescue back. Are you aware of any studies who estimated what would happen if Fed did not intervene in that case?
Yeah.
And didn't?
There's a couple studies by Peter Wollaston, particularly concerning what would have happened if Bear Stearns had been allowed to fail. It's interesting that, of course, some of these studies take time to develop, and it takes a little bit of time after the crisis to sort everything out. But there have been precedents for them. In the 1980s, the biggest bank failure up to that date was the failure of Continental Illinois, and the Fed justified bailing out Continental Illinois on the basis of claims about how many other banks would fail if it didn't have the bailout. But then when the dust settled, people started studying it, and they found that maybe 2 or 3 small banks would have gone under. I suspect that we'll find something similarly true in the case of Bear Stearns, and indeed, I have my doubts whether the failure of Lehman Brothers had the bad consequences sometimes associated with it. I think that the failure of Lehman Brothers was itself a relatively small factor in the so-called credit freeze of 2008. I think what really made that freeze happen was when Paulson and Bernanke went to Congress saying that there was going to be a gigantic depression if they didn't get, I don't know how many, $700 billion to spend any way they wanted to, and so on. That's when the financial markets really panicked on that day. John Taylor has a good event study that distinguishes between the reaction of markets to the failure of Lehman Brothers and then their reaction when Paulson and Bernanke did their little song and dance act for Congress. And the latter is what caused the trouble. I want to say one more thing about the PreFed system. But I hasten to add, I'm not defending that system, and I'll try to make clear. I'm not saying the PreFed system was an ideal system. I'm only saying, in fact, I'm happy to admit that it was a terrible system. It was an unstable system. It was a reckless system. It was a poorly regulated system. That's why, though, being able to show that the Fed's performance has been worse than the performance of that system is really a very serious criticism of the Fed. If I thought the system before the Fed was a good system, then I wouldn't find the Fed's failure so egregious. But one criticism people have about the old system was that because it relied on a gold basis, at least after the Civil War, or after 1879, that it cost too many resources. We had too much investment in gold, and therefore it's a shame to have so many resources going into gold mining that could be used for more productive purposes. But let's think about this the way economists should think about it. The total resources that go into any industry are a function of the relative price of the product of that industry. So it is with gold. If we want to know whether resources are more likely to be devoted to gold mines, we want to look at the relative or real price of gold. Well, the relative or real price of gold has never been higher than it is right now except in the 1980s when it was somewhat higher. And so it's during these periods of great uncertainty about the financial system and about inflation that you actually have the greatest booms to the gold mining industry. In contrast, if you look back to the days of the gold standard, the demand for gold was never that extreme. And that's because other kinds of money were considered close substitutes for gold because they were tied to it. And when you have something that's a close or perfect substitute for something, you don't need as much of the other thing if you have a good substitute. Federal Reserve notes are not considered close substitutes for gold, especially during times of uncertainty. But national banknotes and others that were tied to gold before the Fed were considered close enough so that you didn't bother with gold itself for the most part. And the real demand for gold was actually lower. All right. Now, when I'm saying all these things, I probably have people wondering, okay, does he want to turn the clock back? Does he wish we were back in 1907 or 1890 and had that system again? And my answer is definitely not. That was a very flawed system. Here we have a chart showing the behavior of real US GNP in the period of the PreFed system. And you can see there are lots of ups and downs and panics, and everybody agrees that these panics shown here by these days were due to flaws in the US monetary system, imperfections in the system. But what people don't understand, and what I want to emphasize, is the imperfections of the PreFed system did not consist of the fact that we did not have a central bank. That wasn't the problem. Nor did they consist of the fact that we had gold. They consisted of the fact that the banking and currency arrangements, the regulations during that period, were deeply flawed regulations. Those regulations date back to the Civil War when they were passed to pay for the war. Oh, I had another picture I wanted to show you, and it's gone. Oh, I was going to show you a picture of a national banknote. I'm sorry, I don't have one. Imagine a banknote that says National Bank, and you'll have the idea. During the Civil War, the Union government was desperate to get money for the war. When governments want money to pay for stuff and they don't have enough coming in from taxes and they can't borrow, they do things with their monetary systems. Happens all the time. Happened in the Civil War this way. The government decided that it was going to establish new banks called national banks instead of the state chartered banks that had existed up to that time since 1936. So it passed the National Bank Act, and this ultimately created a new set of nationally chartered banks which could not branch, and so were weak in that respect, just like state banks. But they had a special rule for issuing notes. They could only issue currency if it was backed by U.S. government bonds. Of course, in this way, the banks had to buy the bonds, and that was the fiscal angle to this reform. Now, as long as the government was selling lots of bonds, there were plenty of bonds out there, the banks could issue all the currency they needed to and do so profitably. But after the war, the government didn't need the money anymore, and it actually was running fiscal surpluses for most of the last decades of the 19th century. With these surpluses, the government started retiring its debt. Uh-oh, the debt, the bonds became scarcer and scarcer because there were fewer and fewer of them. And so the banks found it harder and harder to issue currency. This chart shows the consequence. The top line is the one I want to draw your attention to. Imagine this. The U.S. economy is really growing rapidly in the late 19th century. It's a period of robust economic growth. You would think that we would need more currency, right? Not less, as we grew rapidly. But look what happened to the stock of national banknotes. It goes from $350 million in 1880 to less than half of that in 1890. So we have the currency supply dramatically shrinking. After that, new bonds are introduced that relax conditions somewhat. And after 1900, there are further relaxations that help somewhat. But the point is that, especially during this earlier period, you have severe constraints on the currency supply. There's another factor here that's just as important. The US was still a heavily agricultural economy back then. And that meant that at certain times of year, the demand for currency was much greater than at other times of year, particularly during the harvest time from August to November. So normally the banks would simply issue more notes during the harvest and take them back afterwards. But in this system, they would have to get more bonds to back those temporary issues, and that was absolutely prohibitively costly, so they didn't do it. That's why the line is smooth. Anyway, this problem, which was known at the time, the notorious problem of the inelastic supply of national bank currency, is understood by all economic historians to have been perhaps the major cause of recurrent financial crises in the US in the pre-Fed period. But it's due to a regulation that was designed to pay for a war. Let's look at, though, what's happening in Canada during this time. Canada had no central bank until 1935. You can ask me why it did that, created one in 35 if you want to, and I'll happily tell you it wasn't because its system was working badly. So they had large nationwide banks, many of them issuing notes, and here's the pattern. If you were a central planner, if you were like the Politburo of the currency supply of Canada in the 19th century, and you were designing how much currencies they should have, you would probably say, well, let's have it grow over time because the economy is growing, and let's put a little more out there every harvest season. And you would be a very responsible central planner if you did that. But Canada didn't need a central planner or a central bank because its competitive currency system achieved this result spontaneously through the profit-seeking of the bankers, issuing as many notes as they could get away with, but being forced to take them back because of competition when they weren't needed. And here are a bunch of Canadian banks' notes. This is, again, was a very competitive system, survived until 1935. In fact, there were, between 1893 and 1907, a dozen attempts or more of US legislatures to create a deregulated currency system like the Canadian system, because everyone knew then what I'm telling you now. The Canada system was working just fine, and ours was lousy. But special interests in the banking industry prevented all of these measures from being adopted. And it was after the frustration with those attempts, that the emphasis switched to the solution of a central bank. And but the problem remains: our central bank is also not a successful planning agency. It's not a successful counterpart. It's not able to successfully administer the money stock. And this is why we've had all of the defects of the system that I've described to you. And I think it's very important, especially for audiences like yours, to reconsider central banking by realizing that it is a form of central planning, and it suffers from all of the deficiencies of central planning in general. The people in charge do not know enough to get things right. They don't know enough about predicting market conditions. And besides that, their incentives are not always properly aligned with those of the general public. Like any bureaucrats, they have their own agendas. And so this lecture is, first of all, to tell you that even the better central banks are not so hot, but second of all, to encourage you to question the whole central banking approach to monetary stabilization. That's all. So I usually, when I give a talk telling an audience that central banking is a lousy idea, I expect some questions. I don't expect everyone to say, "Oh, that makes sense." Well, thank you, because this is not the consensus. So I hope you will not hesitate to ask me questions, and I'll try to answer them as best as I can. Anyway. Yes.
How many wars
Hi, by the way.
Canada has had?
How many wars?
Yeah.
Well, as part of the British dominions, it went to war in both World War I and World War II.
Something comparable with the American wars.
I'm sure it hasn't had as many wars as we've had.
What's
Yes.
the point here?
I may be leaving some out, but yes,
Yeah,
it has not
because-
had the wars that we've had.
Because you linked this national banknotes, right, to the war.
yes.
How
Yeah.
to raise money to wage the war.
Yes, yes.
So it's maybe a major difference between.
Yes, no, that's quite right. It's probably correct to say that at least part of the reason why Canada never interfered with the natural development of its banking system the way other countries did was because it lacked the fiscal motive to do so. But that doesn't mean that that doesn't mean that the interference in other countries was justified. For example, there have been several studies of the steps taken in the U.S. to pay for the Civil War, including this monetary legislation, that conclude that its ultimate contribution to the war finance was not so great. So when we consider the ultimate costs of this fiscal measure, in terms of monetary instability it ultimately created, in comparison with the apparently somewhat meager revenue advantages it created, it's not clear that this was a desirable step. In any case, though, it was certainly undesirable for the bond deposit and other requirements instituted during the Civil War for revenue to have been kept on the books afterwards when there was no shortage of revenue. And of course, this just goes to show that governments are very bad at repealing laws once their counterproductiveness has become apparent to everyone. There's a big question here that I'm somewhat evading, and that question is, do you want to have central banks or other regulations that might help pay for wars even if they're ruining the performance of the monetary system? That's the big question. And that is a huge question. I tend to think that the answer is no, that at least in modern economies with well-developed fiscal systems, it should never be necessary to pay for a war by messing around with monetary arrangements in ways that are destabilizing. Certainly there's no excuse in the United States. Now, since the 20th century, the U.S. bond market is the most developed in the world. The U.S. tax system is quite flexible. There should be no excuse for inflationary finance or other central bank shenanigans in wartime for such a country.
You presented the United States experience by introducing the central bank. Do we have any other research for other countries experience?
Yeah,
similar.
of course.
They also introduced at some point.
Well, it's interesting, and that's a really good question. The U.S. is actually an exception in being one of the relatively few countries that introduced central banking because it was having trouble with financial instability. So when the Fed was set up, even though it was set up coincident with the outbreak of World War I, it was not set up because of fiscal emergencies. That was just a coincidence. It was set up because there had been a bunch of crises and because other attempted solutions were unsuccessful politically. But if you look at the broad record of central banking, especially of earlier central banks, but also many post-colonial ones, the overwhelming factor behind the creation of central banks has been a fiscal factor. Fiscal and symbolic. And they often go hand in hand. Governments created central banks for the sake of the revenue that the governments could get from these privileged institutions. Or they created them because they felt, and this is more true after World War II, that having your own central bank was a symbol of sovereignty. We saw this, of course, in the post-Soviet countries. A lot of them said, we have to have our own currency and central bank, because if we don't, it's like not having a flag, by God, and we need that. And of course, in a world of fiat money, the temptation to have your own distinct fiat currency is very large. So anyway, the case of the Fed is kind of unusual because crises were behind it, and that was not true for most central banks. Kurt Schuler has a survey article. I think it's the first essay in a book edited by Kevin Dowd. The book is called The Experience of Free Banking. And in Kurt's survey article, he looks at all of the reasons why free banking systems ended and became central banking systems, and he tries to catalog the causes. Yeah.
And actually, how independent is Fed from the government?
Not very. Despite its proclaimed independence, the Federal Reserve is, all central banks are to some considerable extent dependent on their sponsoring governments. This is true not just for the obvious reason that the government appoints the chairman of the Fed and otherwise can influence legislation affecting the Fed. The Federal Reserve is a creature of government, beholden on Congress for its very existence. It's not going to ultimately refuse to cooperate with Congress if that refusal could threaten its survival or its power. And you see central banks, including the Fed, yielding to pressure from their treasuries all the time. Here's a way to think of the Federal Reserve's independence. The Federal Reserve is extremely independent from the Treasury as long as the Treasury isn't asking for much. But if the Treasury wants a lot, the Fed caves in. The Fed caved in World War I. We saw how high inflation got. The Fed caved in World War II, and it caved in the Vietnam War. In all of these episodes, we saw substantial increases in inflation. In the last episode, the Vietnam one, is especially important because that one happened when the Fed had supposedly finally achieved complete independence from the Treasury. So I think the proclaimed independence of the Fed is largely a sham. There's also, on this point, there were a lot of studies in the 80s about the relationship between independence of central banks and inflation, and some of them tried to prove that more independent central banks had less inflation. But if you look closely at these studies, they all had difficulty defining what it is that made a central bank independent. And I think that the bottom line was that they at least came perilously close to having an identification problem where central banks were defined as independent if they had good records with inflation. Right? And then, lo and behold, those central banks that were independent had better records with inflation. So I don't think central bank independence is all that it's cracked up to be. On the other hand, if your central bank is simply an arm of the Treasury, probably you can expect even more fiscal irresponsibility from it. And I think this history does bear that out. There are some critics of the Fed who say that the problem with the Fed is that Congress isn't in charge. I think they're crazy. They miss the point. Yeah.
What is the connection between Fed and the national debt? I mean, does Fed create all this debt which should be paid by the next generations and so on?
The Fed doesn't literally do that, of course. The Treasury decides how much total debt to issue. But the Fed has an influence because the Fed buys a substantial amount of this debt in the course of its ordinary open market operations. If the Fed is buying more debt, the Treasury is tempted to create more debt because the cost of doing so becomes lower. So in a period where, and it works in reverse as well, when the Treasury wants to issue a lot of debt, there's more pressure on the Fed to purchase it. So you have pressure both ways. If the Fed buys a lot of the debt, the Treasury has a temptation to issue more. If the Treasury wants to issue more, it can put pressure on the Fed. So there's a connection between the Fed's conduct and the amount of national debt, but it's not a direct connection.
If we abolish, for example, Fed, will this policy continue?
Which one?
Creating, accumulating this debt.
Yes. Well, to a lesser extent. It depends. You know, actually, it's impossible to answer any question about what will happen when you abolish the Fed without specifying what it is that's taking the Fed's place. So I really can't say what will happen just based on the assumption that the Fed isn't part of the story. But if you don't have a central bank, then the government has one less agency to which it can easily sell debt. And remember, the Treasury doesn't have to pay interest on its debt held by the Fed, because the Fed rebates that, returns that most of that interest to the Treasury. So a Treasury that doesn't have a central bank to rely on will have to issue less debt because it's more expensive. But how much less is a very difficult thing to say.
Is it possible to have a system without central bank but without gold standard?
I think it is possible. Well, sort of. It is and it isn't. So it is, first of all, it is possible to have free banking in the sense of a competitive currency system without a gold standard. You could have free banking in the US or here today if you just allowed the banks to be perfectly free to branch, to issue their own notes, which would then be notes that they have to redeem in the central bank notes. This would be a change that would increase efficiency a lot, and it would have some stabilizing properties, not trivial ones. But it wouldn't get rid of the fundamental problem of a central bank that can arbitrarily manipulate the stock of basic money in the economy, and that determines inflation and so on. Introducing freedom of banking today wouldn't automatically mean abolishing central banking easily. Because the number of occasions when discretionary manipulations of the monetary base would seem necessary or desirable would be much reduced through this more flexible banking system capable of meeting many of the public's monetary needs all by itself. But you still would have to do something in any case to rein in the power of the central bank. In the days of the gold standard, you see, if you got rid of currency monopoly and had competition, that itself killed the central bank because you didn't need it for anything then, because it wasn't the only source of reserves. Today, things aren't so easy. The road to central banking and fiat money is kind of a one-way road. You can't go back the same simple way by reversing the steps that got you where you are. You have to take a different route back.
So I guess we can finish.
Thank you all very much.